Well, hello. Oh, good. Everybody can hear me. Okay. Welcome to tonight's Tuesday night training presented by Wealth Information Network. As our lead educator tonight, the famous Wade Cook. You know, when we can go through a drive-through and somebody in front of us in line at the drive-through recognizes you, stops the line, and comes out to talk to you, and prevents everybody else from getting their Big Macs.
Yeah.
You're famous.
When did that happen? A while ago.
Yeah, down in Arizona. That's the thing. It's not even in our home state.
I know.
That's impressive.
What's really impressive, I'm standing in a Nordstrom store and somebody comes around from behind me and says, "Are you Wade Cook?" Says, "How did you recognize?" She goes, "Your voice. I've heard you on the radio. I've heard your CD so many times. I recognize your voice."
I just said the voice of an angel.
Yeah. Hello, everyone. Are we ready to go?
I think we're ready to go.
Well, let's check and see how many people are there. Thousands upon thousands.
And I should do what is all important for these webinars. I should get the outline up in case nobody's downloaded it.
I don't think anybody's downloaded it. If you're looking on your screen, everyone, you need to get the outline. There's only 2 pages tonight, but we're going to ask you to take a lot of notes tonight.
Hi, Susie Merlin. Lauren from Minnesota. Hello. Aren't they? I think they're doing the Super Bowl in Minnesota next year.
Remember when they did the Ice Bowl up there?
Uh-huh.
Remember that?
Well, I don't remember it. I watched. Yeah.
All the ice sculptors outside the stadium and everything.
That's pretty awesome.
I think that was Minnesota.
Yeah, I think you're right. All right. We've got the outline up. I feel like we haven't done a webinar it feels like forever.
No, it hasn't been. It's been just a few weeks, and here we are again, ready to go with more deals.
All right, well, I'm going to turn the time over to you.
Well, hello, everyone. Again, you're going to need the outline, and we're going to go through some numbers here. I'm going to try to be cool about just giving you so much information. But take a look at the 2 pages of the outline, okay? We're going to list some of the trades right here, and I'll see that in the first box there it says terms of the deal. I'll go through that in just a minute, all right? Then we've got after the terms of the deal, we got 1, 2, 3, 4, or 5 if we need them. But the last one will be like a running totals, which we'll go through. All right. And so when I go through the terms of the deal, that'll kind of explain what our attempt is tonight. Now, our attempt at all times and in all places and in all ways is to get you retired cash flow wealthy. Now, you may not want that. You know, we have to take some people kicking and screaming to get them, you know, to where they're making really good money, because a lot of people just don't think that they're worthy, you know, that they can do it. Well, we're going to change all that. Hopefully tonight, you're going to see some deals, you know, and some of these are pretty common deals. They're ones that we've been using in the TDTs. And, you know, and I'm going to give you a little bit of pretty cool information about a couple of them that you may want to keep foremost in your mind, you know, to see what's going to happen to these. All right. So I'm going to go through this page right here. Okay, and so we need to just go down through it. If you want to, on your outline, all right, you know what? I'm just going to do it with you and for you. Okay, so we're doing it together, all right? So take your marking pen, whatever kind of pen you have, and let's put in there. Here,
focus.
Focus, what?
Get us back in frame.
Oh, what happened?
There you go.
Did I knock us out of focus?
Nope, you're good. I'm just trying to...
Are we making you dizzy?
There we go.
Yeah, this thing's about a half a second slow. All right, so one trade, see, and I'll go through the numbers, but see the numbers right there. That's what I'm doing. Okay, so write in OAS, you know, for Oasis Petroleum, and the stock's at $10.20, right? The $10 calls are 90 by $1, 90 cents by $1. I should have left a little bit more room, all right? And I need a smaller marking pen, right? But then you can't see it unless I use something kind of big and thick like this. Okay, number 2 is going to be AK Steel, AKS, right? The stock's at $5.90. The $6 call is at 46 by 47, all right? Y'all catch up now. You know, write all these, because we're going to keep referring back to these numbers, right? And we're going to try to put together something pretty cool here. Well, is it pretty cool? It's going to be your retirement, right? We definitely want that. Okay, the next one is AMD, Advanced Micro Devices. Okay, this one, the stock is at 11.90. The $12 calls are 77 by 79. Okay, and I'm going to make this number 4 now because I just crossed off the number 4, and it's going to be Rite Aid. Okay, so it's spelled Rite Aid. This is, down the drugstore down the street from you, and the ticker symbol is RAD. Now, there's a lot of talk going on with this company. The options are unbelievable, right? And the stock has sold off because it's gone down, 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 and there was a lot of talk that it was going to get taken over, and the deal kind of didn't go through. Now they're in negotiation with Walgreens and some other big giant pharmaceutical or chain companies and trying to get it approved, this merger. Up here in the Northwest, we have Fred Meyer. Well, they're all over the country now. But the name of this company or whatever consortium is taking this over is called Fred too. So they said Fred is doing this and Fred is doing that, right? And I just hope that Drop Dead Fred doesn't show up and take all the fun away. All right, so the stock's at 370, okay, and the 350 calls are 78. These are calls, 78 cents by 79. Now, these are all for July 21st. All right, now let me interject a quick thought here. A lot of people, not a lot of people, but some people have said, when are you going to start doing weeklies? We might do that coming up. I like weekly covered calls. That, you know what? When we write out a TDT, there's so much copy there, just to get the trades down without even a lot of commentary. There's just a lot of copy. And I hear, not me, I hear that people just don't like to read that much. And I disagree. I try to write it so it's fun and people are engaged in it and they see it coming about and they see it happening and, try to have a lot of fun with it. But I guess the younger mindset, let's see, who's young over here? Well, we got on the other side of the computer, we got a lot of young people, and boy, they want their information quick and dirty, like an egg nab cheeseburger at McDonald's, man. Get in, get out, eat it, and you're done. All right, so, but these numbers are pretty cool. So there you go. There is our seminar for the night. All right, so let me tell you what we're going to do. I just did the numbers by myself, before we got going, and it's pretty cool. We're going to start with $20,000. All right. And basically, we're going to go out and buy on margin $40,000 worth of stock. Now, you don't have to do that. As we said before, margin is a form of debt. But when you put $20,000 into your account, most Americans don't even know this, but you automatically have $40,000 worth of buying power. And that's not 100% true. For a lot of you, you could have $50,000 or $55,000. The lowest margin that can be used is 30%. Now, we always figure margin at 50%, but a 30% margin, that means like if you want to buy $10,000 worth of stock, you have to have $3,000. And your brokerage firm will loan you the rest of that, the other part of that. But we'll just stick with the 50%. All right? At 50% and see what we can do. Now, if you had $20,000, this is your cash, how much would you like that? There's the question of the night. How much would you like that to make for you? What would allow you to retire? Now, you've heard me talk about different numbers. We're constantly trying to get people up to $9,000 a month. That's a big thing that we do. But what would you like? Okay. I mean, like 67.9 or 69.7% of people take around $3,000 home. That's not the gross, that's the net. $3,000. There are so many people that live on $3,000 or even less per month. Would that be good? And if that's not enough to retire, is it at least enough to get one of you staying home half-time or even full-time? Right? Do you see my point? What quality of life would that add? How would you be able to notch up your life if you had the extra $3,000? Now, $20,000 is, that's not chump change. That's a nice little chunk of money. But what if we could get $20,000 to generate, and let's see if we can do it tonight, to generate $3,000 right now. Right now. I mean, well, tomorrow morning when you get going, but, $3,000 a month. And all these trades tonight, this is the terms of our deal, are going to be for the month of July. These are the standard third Friday options, which we typically use. One of the reasons we use the third Friday options is so you can compare apples and apples. And by the way, sometimes you have to be careful when you're on your computer and you're punching up July, and all of a sudden you say, well, the options are 28 cents. Says, man, that doesn't sound right. Oh, that's July 5th or whatever it is, right? And then you punch up July 21st, which is the third Friday of July, and you say, oh, they're 90 cents, right? So world of difference, right? So, but the real question is, let's use the same numbers. The real question is, for the next 3 weeks, what if you can make 40 or 50 cents instead of one time making 90 cents for the whole 3 weeks? Right. So there's a lot of people trading in, weekly options, and I commend them to you. It's just, do you realize what would happen to our TDTs if that happened? Maybe we'll mention one or two of them, but my goodness, whereas like 2-3 pages right now, it would end up being, if we had to deal with all the weekly options, it would end up being 6, 7, 8, 9, 10 pages, right? So you need to know that they exist. You need to check them out. We'll continue to deal with the third Friday options, what we call the standard options, right? And by the way, that's your little question of the evening. I think I've asked this before. If you got the answer, you get an A+. Why, for years and years and years, have standard options expired on the third Friday? Why has the expiration date been the third Friday of the month? Okay, think about it. You got the raise your hand. You got the answer. Raise your hand.
15-second delay.
Oh, I have a 15-second delay?
Something like that.
Really? Between what I'm saying right now and then I...
Who knows?
And I wait 15 seconds and then they hear what I just said?
Yeah, exactly.
Well, has that always been the case?
Yeah, just about.
All right, everyone. You're lagging behind, man. Catch up. Catch up. All right, so 15 seconds. Why the third Friday of the month? All right, here is the answer. There are no national holidays on the third Friday of the month.
Susie and Merlin got it.
Did they get it? What did they say?
No federal holiday.
Yep. No. What does that mean, by the way? Even when Easter, in April or whatever, comes up, they have Good Friday, and sometimes they celebrate on Monday, and sometimes half a day on Friday. But there's no expiration date on the third Friday of the month. One year I saw that the third Friday that month was the third Thursday, right? Or it was the Thursday before the third Friday. Okay, so there's no holidays. I mean, think about it. Most of the holidays that we have are the first part of the month or the ending of the month, right? And then there's Columbus Day, there's Veterans Day, there's Christmas, which is always the 25th. So there's never a holiday on the third Friday. So why is that important? Because millions of stocks are controlled by options, and we can't have wandering expiration dates. We need to get something in our brain, something that is fortified in our brain so that we can deal with this reality instead of a whole bunch of wishy-washy realities that change every time we turn around. All right. So that was just for fun. If you didn't get it, you better get it next time, because I'm going to keep testing you on it. Right. I like people in my life that learn how to, if they don't know how to, they learn how to think. So who got that one right?
Susie and Merlin.
Susie and Merlin, you get a hold of us, or I don't know how you get a hold of us, all right? And we're going to give you a free book, a book of your choice. So go to the bookstore, not the big manuals and all that, but like if you want to get 101 ways to make money in the stock market, turbo money, whatever book you want, we're going to download it to you, and you're going to have that book, all right? Okay, so here we go. We're going to now here's our numbers up here. We're going to take the $20,000 and we're going to buy $40,000 worth of stock. Now, in doing the math for that, we need to make sure that we are talking apples and apples, right? I can't be writing down $4,000, and that's going to buy 2,000 shares at 8,000, then we divide it by 2. See, it just gets so confusing. So I'm going to try to be very careful, and that we don't double dip the money. We take the actual hard cash. So when we get done, the money that we spend better be around $20,000, and it could buy around $40,000 worth of stock. So then you've only got this much cash tied up, $20,000. So you can't say, well, we just made $3,000 or $4,000. You can't say that on $40,000. No, you made it on the amount of cash that you have tied up. Remember, the broker is going to loan you the rest of this, right? Whatever the deficiency is. This gives you buying power. And by the way, the very next day, if some of these stocks go up, hey, your buying power might increase another $800, another $1,000. You might have enough buying power to buy some more stock. Now, I don't think you should spend all your money, all your buying power, because then if the stocks go down, there's a margin call. You don't like those, right? By the way, we should have another event. Maybe a couple Tuesdays from right now, we'll have an event where we deal with margin calls. All right, so here we go. Let's start. I'm going to put up the numbers again. Okay, so in our box right here, we're going to do OAS. Okay, Oasis Petroleum. Okay, I got to get my numbers out. Okay, here it is. Okay, I'm going to set it back over here so we have all the numbers. Okay, the stock's at $10.20. Right? I'm going to try to get it all into this box so that you see it all. Okay, we're going to buy 1,000 shares times the 1020, which would be $10,200. Right? So there's your total, $10,200. Right? Now we divide by 2 for margin, and we have $5,100. Okay, $5,100. Now we're going to sell the $10 calls. All right. Now, do you remember what the we didn't put in the option prices here, did we? Yeah, we did, didn't we? Okay, so the $10 calls. Remember those? The $10 calls were 90 cents by $1. So let's sell them for 90 cents. How many shares do we have? Well, we have 1,000 shares, right? Make sure this is right. $10. Yeah, we only put up 50. So we have $5,100 tied up, and we're going to sell, 10 contracts of the $10 calls, and we're going to take in $900. Now, if we get called out, that's $900. Now look at this. I know I'm trying to talk the talk and walk the walk, right? If we did this trade, and if we did get called out, right, we would have to give back, and that's just a word that we made up. You would basically have a capital loss. You would buy the stock at 10.20, and you'd sell it for 10, right? Now, you and I know from all of our studies together that as time goes on and as the option comes down in price, that you might be able to buy back those $10 calls for 20 cents or 30 cents or whatever, right? But right now we would take $900 and we would subtract from that the $200, the in the money portion. We would have $700. So on our first trade, we have $5,100 to make $700. Okay, now anytime you have a question, you just type it in over there. Oh, we would love some of you to come on here. Right?
Well, and we do have a question.
Okay.
You have perfect timing.
What is your question? Who is it?
Lauren asks, what are your thoughts on in the money calls sometimes deep? So it actually goes perfectly with this.
Okay, I'll just tell you what I like, because I really like double dipping, if at all possible, where you sell the option, you try to buy it back and sell it again. That's really tough to do with an in the money call. So for example, on this one right here, my goodness, we sold at 10. That's what we're doing here. That's a slightly in the money call, right? What if we sold the $9 calls or the $8 calls? We would put a lot more cash into our account, but pretty soon as you go deeper in the money, right, pretty soon the whole option price is almost all in the money portion, right? Let me say that another way. I like buying a stock and selling the fluff of the option. When you do a deep in the money call, there's no fluff in the option after a while, right? I mean, I've seen a stock like this one, 10.20. The $8 calls are going for $2.30. Let me say that again. The stock's at 10.20, and the $8 calls could be going for $2.30. See that? It's $2.20 in the money, and there's only 10 cents of fluff in the option. It just goes away. Pretty soon, it's almost all what is called intrinsic value. It's called in the money, right? And there's no speculative value. There's no time value left, right? So let me say it again. I'll just give you the punchline. I like, this is me, after about 11,000 of these trades, I like selling slightly out of the money calls or near the money calls, right? If it's at $10.20, the $11 calls are not going for very much at all. So I'll go ahead and sell the $10 call. And by the way, this stock has been pretty volatile around that $9.50, $10.50 range, right? Remember, now you know this, every time you go to the gas pump, the gas station, oil prices are changing. So as a barrel of oil comes down, within a week or two, you see the oil, usually the market does better, but you see that these oil stock prices go down, and sometimes even airlines go up and down based on the price of a barrel of oil. All right, so let's just stick with this. Get back to our example. I hope that answers your question. If it doesn't, let me know. Okay, I always want to improve. All right, so $700 on $5,900 or $5,100. Okay, I will give you the totals here in just a minute. Okay, our next trade is going to be the Rite Aid, just like what we talked about a few minutes ago. Rite Aid. Ticker symbol is RAD. The stock has gone down. If you look at a 6-month chart on it or a 1-year chart, the stock's now at 370. Okay, I want to buy on this one here. I want to buy 2,000 shares. So we take 2,000, right, times our 370, and we get $7,400. Okay. But now, if you divide that by 2 for the margin, then we get back to the $3,700. Now, we could have done it the other way. We could have just used $3,700 and bought 2,000 shares. However you want to get to it, you pretty much come out the same. All right, now, here's the interesting part. All right, the 350s. The 350 calls are going for 78 cents. Now let's look at that for a minute. We bought the stock at 370 and we're selling the 350 call. Once again, we're 20 cents in the money, right? But we take in 78 cents times our 2,000. My goodness, we take in $1,560. Now, $1,560. Look at this. $3,700. My goodness, look at that. Almost half of that money is tied up in just what we're going to take in options. Pretty cool, right? Again, that speaks to a little bit of volatility. If the trade doesn't go through, the takeover of Rite Aid, and I don't know, this is a little bit speculative, but you're getting paid really well to take the speculation. But you got to decide. Do you want the stock to go down? Most of us don't. So that's a lot, right, to buy 2,000 shares. Okay. Now you see that it's at 370. Right? And if we sell it for 350, we're going to have to give back that 20 cents. You see that? The 370 down to the 350. Well, we have 2,000 shares. So 20 cents, right, times the 2,000 is $400. We would make $1,160. Shoot, I didn't want to write out of the box, but I did. Everybody keeps telling me, stay between the lines. Stay between the lines. Well, I just went out of the lines. All right, so deal with it. All right. So
I'm
that.
going to jump in really quick.
Okay.
2 more comments. Lauren said, so in the money is good in this case, referring, I think, back to OAS.
Well, hang on. Okay, back to OAS. Why? Because if you're going to sell in the monies at the 9s or the 8s, it's almost all in the money, right? You're not getting any fluffy value out of that. And if you were to sell the 11s or even the 12s, you're not going to get very much money. So maybe I should just come up with a new slogan. We sell near the money, at the money, or slightly at the money, slightly above, slightly below the strike price. Okay?
Oh, and okay, so Lauren was talking RAD too, but yeah.
Okay, so it's the same thing here.
Yeah.
The $4 calls, right? These are the 350s for July. The $4 calls, there's hardly anything in them. It's just not worth our attention. Here, if I was ever going to sell one in the money with the speculation going on about Rite Aid, I would sell the $3 calls. Right? I think that might even be a better trade. You put more cash in your pocket now, but then there'll be a bigger give back on the capital gain, if you were to get called out at the lower strike price.
And then,
okay, other questions?
And then Barry says, and I think this is referencing margin in general.
Yep.
My fear is if the stock falls 20% or more for any reason, margin call and major loss, and the market can change at any time.
Well, okay. Well, yes, it can. Let me deal with the margin. You should not be doing margin if you're right at the edge. Right now, that if you have $20,000, you won't even put any of that money on margin until you basically have used up or spent the whole $20,000. Right? If you've got $14,000 in your account, cash available, and you buy this stock, it's all going to be the cash that you have. But once you've spent the $20,000, then that will start to go into margin. Now, I really recommend. We got a whole bunch of ways to deal with margin calls. Having to come up with more money. But try to avoid that scenario. You're right, Barry. Try to avoid it, right? So have some extra money, because if the stock goes down, you don't want your broker having to sell the stock, right, to cover a margin call. Man, you don't want that, right? That's really bad. So you don't get that. So keep some cash on hand. or avoid doing all of it on margin or even half of it on margin. Just avoid it. You don't have to, because even if you have the $3,700 tied up, and you only have 1,000 of these, 1,000 shares, you're still going to take in, what was that, 800 and some dollars? I mean, $780. It's not bad. It's not bad. So, this is a personal judgment call, right? Yeah, and Barry, you're right. When in doubt, be cautious, especially as you come into the summer months. Now, there might be a summer rally, but then there's also the summer doldrums. So just be careful. Okay, our next entree for the evening is, where did it go, Brandon? AMD?
Yep.
I don't see where it got to here. Oh, there it is. It's hiding. Okay, sorry, everyone. AMD is, you know what? Now that I've written it, I wanted to do AKS first, okay? AMD. Now, there's a really cool thing between AMD and AKS, just the numbers, right? There's no relationship between the two stocks, all right? But AMD is at $11.90. Okay, so if we were to buy 1,000 shares, right, we would have $11,900 tied up, right? If we divide that by 2 for the margin part of it. Now, if there's any stock that we're talking about today that I would consider doing margin on, well, I would do OAS, but I'd also do AMD. Stock's been around, Advanced Micro Devices, right? But you take that AMD, then you have $5,900. If you divide by 2, it's $5,900, $5,950. All right. Now the options are going for the 77 cents. So we take 77 cents. We take that times 10 contracts or 1,000 shares, and we have $770. Okay, that's not bad, $770. But look at this also. These are the $12 calls. The $12 calls. So $11.90 up to the $12 would be another 10 cents. All right. We have how many shares? 1,000. So we could add on another $100 if we were to get called out at this higher strike price. I'm saying we probably won't. Knowing what we know about the buyback, we probably would buy this back, but that's $870. Okay, not bad on $5,900 on a fairly good, widely traded stock. All right, I want you to see something. This is kind of cool. Okay, let's move on to AKS. Again, keep your questions, your letters, and your comments coming. I love it. Okay, so AKS, AK Steel, and I like X Steel, US Steel, but there's a lot of talk going on about the infrastructure of this country, and President Trump is now saying that if you're going to build American pipelines, we're going to use American pipe, things like that. That's pretty interesting. Okay, AKS is going for $5.90, right? $5.90. So let's just take it right up. So that'd be $5,900 to buy $5,900 cash would buy 2,000 shares. Okay. And with 2,000 shares, we sell the $6 calls are going for 46 cents. 46 cents, per option. We might be able to get 47 or 48, but 46 cents per option would be times our 2,000 shares would be $960, right? 2,000 times 46, $960. Why isn't that 920? What is it, Brandon? Did I mess up here?
Yes.
It should be 920. Sorry, everyone. Now I got to mess it up, right? But $920. Okay, now, and we would make an extra 10 cents. Right? I should have just forgot the 20. We'd make an extra 10 cents, right? $5.90 up to $6, and 10 cents times our 2,000 shares would be $200. So it'd be $11,120. Okay, I had 1160 over there, but it's 1120. I'm glad we caught that. All right, now let's do the running totals. Okay, let's just see what we've done. We'll deal with some more of your questions, but let's just see what we have done. All right, and by the way, I'll give you our runners up. Believe it or not, there's the 4 that we just did. Global, what's it called, Brandon? Global GSAT, Global 210. The $2 calls are 25 cents. By 35, we could probably get 30. And BlackBerry. Now, BlackBerry's doing really well. They got down around $6, $7, and it's doing really well. A lot of companies, a lot of people were writing that off as debt. Just remember, BlackBerry is a Canadian company. And I'm half Canadian, so I can say this. Those crazy Canucks. Their year end, believe it or not, is August 31st. No. That's their quarter end. It's February 28th is their calendar year end, right? So there are always like 3, 4, 5 weeks. So when all the other companies are announcing earnings, then about a week or two later, BlackBerry announces earnings, right? It's always strange. These were the runners up, right? BlackBerry 11.15, the $11 calls were 83 cents. All right, let's come back now to our running totals. Okay, here we go. Got to change that one. So here's our running totals. OAS, right? $5,100 that we put up and we took in 700. Okay, and that's after the buyback. Okay, then we have Rite Aid, which is 3,700. Okay, and we took in 960. $960. Okay, I don't know where to put the rest of this. It's going to be a little bit crowded here. AKS is 5,900. And this we took in 1,120, right? And then we have AMD. I'm going to just put it down here. Sorry. I need a bigger box. Okay, AMD is 5,950. And we took in 870. Our total for all of this is, for all of these numbers here, is 3,600, and I have 90, but we got to take away that other $40. $3,650. If I'm a little bit off, that's okay, because we haven't figured in commissions, we haven't figured in any margin interest, which is really minimal. And one of my adages, don't go tripping over pennies on your way to dollars, right? Just think about this. This is $20,000, right? Just slightly above that, by the way, when we add it up. $20,000 to make $3,650. You know, if you're after 10% a month, that would have been $2,000, right? If you want to back off some of these trades and not do them on margin, it would still be pretty high. You could probably still generate $2,000, $2,500. But back to my first question when we first started this, what if you had an extra $3,000 coming in? I mean, I'll help you paint a picture of your retirement. But when I paint a picture of your retirement, there's going to be a little door right down there at the bottom of the picture. That's your exit strategy. What is your exit strategy here? What is it? Okay, so what do you think? Okay, Brandon, we have any more questions?
Yeah, okay, so a few points. Barry, and I think this is after AMD, said you used to love channeling. Any chance of that system?
Which one?
I think it was right after AMD.
A stock that I mentioned? What was his question?
You used to love channeling. Any chance of that system?
Channeling is rolling stocks. Yeah, we got a whole bunch of stuff on Trail. Just go on Trail and look. Just click on rolling stocks. You know, we're not doing any active ones right now. Right now, we do more of a rolling covered call. But channeling and rolling stocks and stocks that travel between a support at the bottom and a resistance level, that's a big part. Matter of fact, I look for stock charts like that all the time. When I find a really good one, I report it on Trail, right? And if you find any, by the way, report it to me, and I'll get it out there so we can all benefit. Okay? Yeah, I still love channeling, but I don't call it channeling. Right? Some of my copycats, they start calling it channeling so they could get on TV and say, "Look at this stock going over." Okay, but I call it rolling stock. Okay. Any other questions?
Yep. Two and a half more. Mr. Wade, this is just great.
Somebody just called me Mr. Wade.
Mr. Wade.
Wow.
This is just great. This is what I need. The way you are making it so practical, giving us real life vision of what could be. Wow.
Okay. Now, can I propose something to you? I'm not suggesting this. We've been toying lately in our discussions about having an event, like not an event, but we'll just come into the studio and record, maybe use the whiteboard behind me, maybe do what we did here, right? To record our TDT, our $1,000 Thursday, right? So, you know, we would do something like this, and it would take us a little bit longer. We kind of decided not to do that because the written format is cool and you can read as much as you want. And, you know, you don't have to get on a video and sit there, right? You can just take it with you. You go into lunch, you can read a bunch of trades, you can print it out. So we'll probably keep TDT the same. But again, we love these video conferences and love getting you involved. And hopefully you can see these numbers come alive. So again, thanks for your comments. Anything else?
Yep. Lauren says, so what are your thoughts on diversification? And not all trades may go your way. And then it also says this does assume all trades go your way.
Yes, it does. And so let's talk about what you do. First of all, the question is diversification. You notice here that if I wanted to really show off and show you a big number, we could just take all the money right? All the 20,000 and buy, God, we could buy thousands of shares of Rite Aid, right? And this $3,600 we just made would be like $6,000 or $7,000, right? So diversification. I believe in doing even incremental trades. So we didn't do that exactly tonight, but you need to determine what kind of an investor you are. When I say what kind of a dollar investor are you? So if you have $20,000, my thought was that you would say divide it by 4 or divide it by 5 even. And so you would do 4 $5,000 trades. That's kind of what I was leaning for tonight. Right. And I put less money, by the way, instead of more into Rite Aid, into RAD. Right. So that's one thing. Do even incremental trades. You're not going to get it perfect, right? Because it's going to be 5,200, 4,800. But do even incremental trades. Don't be doing $1,000 on one trade, $800 on another, and then $8,200 on another to get it $10,000 or $20,000. You could do the same thing, right? This could double. And this could lose 10% and you're about the same amount of money. So do even incremental trades. That's one of the keys to building sure and steady income. Okay, now the next part of his question was what, Brendan?
Oh, just saying that it assumes that all the trades go your way.
Yes.
Yeah.
So what are you going to do? What are you going to do to protect yourself? Right? I've been doing these for years. One of the most common comments I made was, Wade, even when the market is up and down, writing covered calls saved my fanny. I hear that all the time. And if I hadn't had the stop loss, I would have been really, out of it. Well, a lot of us don't like the stop loss that much, but whenever we really think about it, it's a stop loss that saves our fanny, right? So if nothing else, protect yourself, use a stop loss, right? The first thing, by the way, before you use a stop loss is make sure that hopefully that the stock's going up. We've kind of violated that a little bit tonight with RAD, but that the stock is going up. That's A. B is a stop loss. Now, if nothing else, go down either 10% of the stock or go down the amount of the premium that you just took in the option. So if you do have the stock go down, it could go down, 40 cents and 80 cents and all that, right? So you're out of the stock, right? You weed the garden. You get better at weeding the garden. So sometimes, my goodness, sometimes you do a stop loss and it drops down there and they pick you off, right? And they sell it to you. So you got a stock that you bought at 420 and you put in a 340 stop loss. The next day, it just drops down to 340. They pick you up and it's back up to 440 by the end of the day. That has happened to me way too many times. It's almost a Wade Cook guy. Man, he's got a best-selling book. We're going to just make his life difficult, right? And they're watching what I'm doing and they're going to just get in there and pick me off and buy my stock at the lower price and then drive it right back up again. I don't know. All right. So don't forget your stop loss. And in paid to trade, right, there's a whole section on stop losses. So make sure you keep studying and studying and studying. Become a student of this process. Okay, was there another part to that question?
There's another one now. Yeah, with a stop loss, don't I need to sell the option first?
Oh, boy. I almost hate dealing with this question. Again, if you go to pay to trade, you're going to see my comment there, but I'm going to go ahead and deal with it right now. I'm going to grab me a new clean piece of paper. Well, it's a semi-clean piece of paper. It looks like this one was playing football before we got in here. All right. You're right. Stop losses in most brokerage firms can be done, and if you have a good stockbroker, they will allow you to write a covered call on a stock and also have a stop loss. I've never seen one online brokerage account that allows you to do that. So if you bought a stock at $8.80 and you have a stop loss at $8, right, they won't let you write the $9 call. Okay, so let me tell you how to do that if you want to play that game. It is this. Okay, and in lieu of, by the way, doing an official stop loss, at least put in an alert at $8 or $8.40 or whatever. So you got an alert in there so you're notified that your stock is going down a little bit. If you have the ability to write an uncovered call, I got to tell you what I didn't say. I didn't say write an uncovered call. I've done those before. They're a little bit riskier. So you buy a stock, you don't buy the stock at $8.80 and you just go out there and sell the $9 call. Now that's a very bearish strategy because you don't want the stock to go above $9, right? Matter of fact, you wouldn't even mind it going down to 820, 840. If you don't own the stock, what do you care, right? You wrote the covered call, you picked up a nice premium, and then you can watch the stock go down. Most brokerage firms will not allow you to do that. Now, if you have a brokerage firm with a real live stockbroker and somebody that's really a good technician, really a good mechanic of these deals, they will let you write an uncovered call because that's what it is. Now we can talk about uncovered calls at another time, right? Just write down so we can study this. And this, by the way, is mentioned in Paid to Trade. It's what is called a buy stop. BUY-STOP. We don't need to discuss it now, but when you write an uncovered call, you put in the exact opposite of a stop loss, which is a buy stop, that if the stock starts to rise at 880 up to 920, 940, that you have an order in to buy that stock to stop it at, say, 940, right? So you don't get stuck with a stock that's, it's going to go way up there, and then you got to buy it at a higher price to deliver it at a lower price. All right. So I wish I had better news. If any of you have found a really good brokerage firm with a paper trading or a practice trading, a virtual trading section to it, I've checked out a lot of them, and they all are lacking. I haven't found one that I really could endorse, one that I really like, right? Because they just, I don't know, they don't treat us like real investors. Because a real investor would like to write a covered call and also put in a stop loss to protect the downside of the stock. But then the brokerage firm said, oh, you can't do that. Well, why not? Why not? Let's put in a stop loss. And then if the stock drops down to the stop loss and we're taken out, then, and by the way, think about that. If we have the right to write an uncovered call and the stock drops down, we're taken out of the stock. Now our option keeps going down. Well, hey, you're in a naked position. You're in an uncovered position, but as you move towards retirement, as you move towards the expiration date, right, that option can become worth nothing, right? So you sold it for 80 cents, you sold it for $1.20, and now you could buy it back and end it at 10 cents. Now think that through. If you have a stock that has gone down in value, usually, I haven't found a place where it hasn't happened. Usually the options also go down in value, right? So you sell the stock at a lower price, but then you can buy back the option at a lower price. It's almost always happened. But if your broker's saying, well, we just won't allow you to do that, I keep saying, why? Why not? What's wrong with this? But I don't know. They don't want to get sued. They don't want to do anything that's really weird. And having an uncovered call where you don't own the stock, that to them is weird. And it really isn't that weird if you think about it. All right. So does that answer your question? That's not a beginner's question. That's an intermediate question. I commend you for it. But you're just going to have to do the best you can. Get a practice account that works that way. I haven't been able to find a very good one. Find a broker, somebody you can talk to, and show them what you want to do with writing a covered call, right? And then a stop loss on there so you get taken out of the stock. If they want to marry those two together, we'll take you out of the stock, right? We'll sell the stock at this lower price, but then we have to buy back the option. Well, okay, we'll do that. But what if you don't want to buy back the option? It's Thursday. It's Wednesday of expiration week. My goodness. You've got a stock that you bought at $9.80. You got taken out at $9, right? And you own the $10 call. Well, the stock's down to $9. The $10 call is a nickel, right? So you say, well, I got 1,000 shares, a nickel. Well, 1,000 times a nickel is $50. I can go ahead and spend $50, but you know what, George? If we could just wait till Friday, that option's going to expire, and I don't even have to spend $50 plus a commission. All right, you see the logic? Well, most people in life don't like to be logical, so you're just going to have to deal with it. Okay, any other questions, Brendan?
Nope. You talk about it extensively in your books. I have them all. It's great hearing it directly from you.
Well, I got to tell you, everyone, I love being here. Now, I want to tell you something very quickly, right? We are planning a special event for next Wednesday night. It's called Health and Wealth, right? We're going to show you how to balance out the energy in your body. We've discovered a product, right? And I've spent 34 years of my life helping people build their wealth. Now, I'm going to spend a little bit of time. Well, it's an important time to help people regain their health, live a better life. Now, I don't know if you notice a difference in me. I'm dropping weight. I'm 23 pounds. I just weighed myself this morning. In the last little over a month, 5 weeks, I've lost 23 pounds. My son's lost 32. My wife, my goodness, I saw her this morning. Is like the incredible shrinking woman, right? She's down over 20 pounds, right? And it's not a weight loss product. That's what it's not. It's an energy product, all right, about ketones. So I'm just going to give you a little bit. Next Wednesday night, and it is going to be a blast. We're going to bring on a doctor, Dr. Heather Carden. She's going to come on for about 20 minutes. I'm going to interview her. You're going to have a lot of fun. So let me just tell you what you can do right now if you want to get ready. First of all, let us know that you want to get ready, and I'll send you a letter and a few other things that you can read. If you want to get ready for that event, you can go to, Brian, what's the name of our, it's a YouTube. Is it go YouTube / Keto Power, KETO Power, right? And you'll see me and Dr. Heather. I did an interview with her already. There's a couple of other things on there. We did a couple more videos today that are going to be posted, right? And that's a safe site. A lot of different people that are involved in this company, they don't want to give out the site because they might think someone's going to steal their customer. No, that is a safe site. We're in it for pure education purposes. I think you'll be pleasantly surprised when you see what's going on. I am happy. I'm telling jokes again. I haven't felt this good. Even my daughter Rachel, who's here, she's feeling better than she's felt in a long time. My wife and everybody, except for one guy named Steve, right? Everybody that I've introduced this to is feeling really good. They've got more energy. They're sleeping better. It's an amazing product. It's a new discovery. It is literally cutting edge, state of the art. I guarantee you, even if you're into ketogenic diets and that sort of thing, you've never seen anything. You've never heard anything like this. And don't say you have, because I will show you next Wednesday that this is a product that is worthy of your attention. So come and spend a good half hour, 45 minutes with me next Wednesday on the Wednesdays with Wade. Again, it'll be called Health and Wealth, and we will have a blast when we get there. The two of you that got the right answer, make sure you let us know, and we'll get that book sent off to you. We love you guys. We appreciate you. We love you being on here with us, and we really like your questions, right? That's really a lot of fun. All right, so this is Wade Cook signing off from the huge staff here at Wealth Information Network. We bid thee adieu.